looking at some of the names here that have gotten expensive in just about every valuation metric, Octavio, but do those metrics matter? Because we're getting some of the things from the economy that people said might push investors towards other stocks, better COVID curves, better data, doesn't matter. Still just piling into Netflix.
Yeah, I mean, it's kind of amazing to watch. A lot of these tech companies have seen their stock just explode since COVID, or since the low point, which was around March 20th. And so we've just seen enormous gains in these tech stocks. I think the tech stock that exemplifies that better than any is probably Apple, that is up 150% on the year about. So we're seeing really extraordinary amounts of money going into that. And it seems somewhat divorced from the actual performance of these companies. So I don't think there's much in Apple's performance and the actual underlying financial performance that would lead you to believe that 150% increase in its stock price is justified. And even if you look at other tech companies that haven't done as well as Apple, I mean, Apple's revenues are up about 10, 11%, something of that sort, so low double-digit gains in terms of revenues, which is decent, especially considering the environment they're working in. But something like Google too is up at a huge amount, and their revenues have been fairly stagnant. So it doesn't seem to matter what the economic fundamentals are of these tech stocks, just more and more money is plowing into them, and they're just going through the roof.
So do any of the traditional metrics, and history books about how to try and gauge real value for a company or overvalue, or whether or not, now is a good time to buy, sell, all that stuff, do we just have to throw it out the window? I mean, are your options here either buy stocks, buy tech stocks, or don't buy tech stocks? Is shorting not an option?
It's so hard to say. I think so many of those normal ways of measuring stocks are really out the window, as you point out. It's very hard to sort of say where are the fundamentals and where the stock price are going to land. So in terms of target prices on the stock, it's almost impossible. It's almost a fool's errand to even try and do that. So I'd encourage people to sort of stay away from that and not try and guess whether things are going to go up or down or sideways. I think what we are seeing is, more than anything, the Fed's very, very easy monetary policy has led to just a wall of liquidity coming into into tech stocks in particular, and it's coming in a fairly indiscriminate way. So as I pointed out before, you've seen some stocks like Amazon and Netflix who've got very, very strong increases in revenues, probably as a result of COVID-19 quite directly, but other stocks haven't done as well, and still they're seeing things go up. So I think it's clear there's something else driving. It's not the economic fundamentals, it's not the financial performance of the firms, it is just this wall of cash coming from the Fed. And as long as that continues, I think we can expect tech stocks to continue to do quite well.
I hear you on this, Octavio, because we did have a test last year, whereas the Fed drew back from its cuts and held off in the fall. We had rates start to spike, and some of these cloud companies got hit. WeWork blew up at the same time, and while the high valuation stocks were under pressure. However, over the last 5 months here, I mean, to say it's all one thing or all the other, do we not have to be careful with that? Because once again, we are seeing some bottom line and top line growth in these companies that are providing services we need to basically live and function in a work from home. But also, I mean, let's just look at 10-year yield. I know it's really low. We're at 70 bips right now, but at the worst part of the crisis, we were at 50. So if you're kind of using valuations based on yields, that hasn't changed in 5 months. So something else is going on, right? Besides just yields diving. Our low was in March.
No, I mean, there's definitely some of these stocks that have done well and are really providing essential services. So if you look at Amazon, they've seen very, very strong growth in their revenues overall under COVID-19. But even with a stock like that, you have to ask yourself, well, what happens when things return to normal? Are they going to be able to carry on growing at that pace? And I think what it looks like is the market is almost expecting that Amazon's growth will continue forever at the pace it has over the course of the past half year. Now, that, I think, might end up being a foolish assumption. So there's certainly, I think to say it's only one thing is to oversimplify it perhaps a bit, but it does seem as an overall sort of systemic factor driving these stocks forward. So we've seen some do very well. Amazon's done very well in terms of revenue growth and profitability growth. Netflix has done pretty well as well. Firms like Apple, and Apple's up 150% on the year. I mean, it's got decent revenue growth, 10, 11%, something of that sort. It's seen maybe slightly higher than that in its services side, which covers things like iTunes and Apple Music and stuff like that. But I think if you look at a company like Apple, there's little there that would lead you to conclude that the stock price should have more than doubled in a year. There's just not that much there. And we're looking at very, very high price earnings multiples, certainly on a historical basis, and compared to other sectors, it's looking very, very high. These are looking like nosebleed levels for tech stocks, I think, at this stage.